Here's another question from Mike. Key indicators, sectors, etc. you watch each day. You know, that's a good question because I think the market tends to flow in terms of what it's faced with. What I do is I run my own thing, which is away from moving averages on a percent basis. So we have a live spreadsheet, which actually, while I talk, I'll see if I can pull one up for you. We have a live spreadsheet that runs with a variety of studies, and those studies are away from the 20, 65, 200-day as well as the historicals against it. So in other words, when a market moves significantly, I still subscribe to the rubber band theory, and that rubber band theory is basically that every market has a price at which you should be a buyer or a seller. And when we're too stretched out, this we call it the heat chart. This heat chart tends to be a great contrary type of indicator, and in fact has probably, I mean, it's made us a lot of money, but it's probably saved us from mistakes more than anything else. So I'm going to pull that up for you. There we go. Bear with me for a second. This is, let's see if I can slide this over. Okay, can everybody see this? So this is just a simple run into Excel.
Yes, we can.
Let me, move this thing. Okay, so as you can see, what this shows is each, this is the percent from the 21 and 10-day moving average. Now this, I've got to enable the content because that's an old one, so it'll take a minute to update. But as you can see, this thing was actually, this is back from a few weeks ago, when they were all negative, and you could see how overdone we were. The black arrows is the historic norm, and now as you can see the market changing, you can see why you wanted to be a buyer down in there. So currently, overbought, oversold. So the overbought reading in the S&P is still another few percentage away, points away on the moving average. Same, you know, Nasdaq's very flat, E-mini Russell, but obviously at the time, the first picture I showed you is when they were really stretched out. So this is a great little, you know, as we call it, the heat map. It provides a thing from getting, I guess, away from getting a little bit too stupid sometimes with the momentum, getting carried away from the momentum. Typically everybody's really bulled up at the top and bared up at the bottom. So that's one way. Now we also run the 200-day, 65-day, and things like that as well on some different sheets. But that's a nice little indicator. So that's one thing that I'll look at every day no matter what. As far as sectors and things, you know, it depends. I mean, right now, obviously, the banking sector, money centers on a global basis are important. And, you know, that can shift. I mean, when you have correlations running as high as they are, it's very tough to get an edge, I think, on any sector right now. How do you calculate what is normal in the spreadsheet you just showed? The overbought and oversold with the arrows on what I showed, that is basically, that's 6 years of data that has kind of been retrofitted in terms of areas where the market has historically stopped. Now that doesn't mean it can't go, you know, in special situations well through it, and that's why it's not necessarily a buy when you reach it on the downside or a sell when you reach it on the top side. It's really more of a indicator that, you know, you could get flat, you could look to do an option spread trade on it, you could do some things like that, but it's risky getting long or short depending on in which direction the extension is. Do you key off volume data as an entry or sell for your